Hold on to your charging cables, folks. The future of two of the largest publicly held charging networks in the US, ChargePoint and Blink Charging, is looking uncertain. With dwindling cash reserves and increasing competition, could we be seeing the end of an era? And what does this mean for their stock prices? Stay tuned as we dive deep into this electrifying news. The car industry has been buzzing with carmakers increasingly leaning towards the Tesla Supercharging network, or even considering creating their own charging stations. This shift poses a significant threat to ChargePoint and Blink Charging. Recent quarterly filings from both companies paint a grim picture. ChargePoint's net cash used in operating activities in the fiscal first quarter surged from $71 million to a whopping $104 million. Their cash reserves plummeted from $541 million to just $314 million. Even though they're aiming to cut their losses by 2/3 by the fiscal fourth quarter ending January 31st, the horizon looks stormy. Blink Charging is sailing in similarly turbulent waters. They've spent $65 million in the first half of this year, which is more than double the $31 million they spent in the first half of 2022. With a mere $75 million of cash left, they're grappling with outdated technologies and reliability issues. This has left many EV owners frustrated, pushing Blink to focus on improving the quality of its chargers. Companies like ChargePoint and Blink, along with EVgo, were once seen as potential rivals to Tesla's Supercharger. ChargePoint even formed partnerships with big names like Mercedes-Benz, Toyota, and Lexus. Blink wasn't far behind, collaborating with Mitsubishi, Subaru, and General Motors. However, the tide seems to be turning. Many car manufacturers are pointing to reliability issues as the reason they're now aligning with Tesla's North American Charging Standard connector. This means their new EVs will be compatible with the Supercharger network. Guidehouse Insights analyst Sam Abuelsamid described the situation as a perfect storm for these charging companies. They're facing stiff competition, unhappy customers, and a dire need for funds they can't seem to secure. To add salt to the wound, a recent J.D. Power survey highlighted that charging network satisfaction is at its lowest, with about 1 in 5 charging attempts failing. And if that wasn't enough, big players like BMW, GM, Honda, Hyundai, Kia, Mercedes-Benz, and Stellantis have announced a joint venture to set up their own EV charging network in North America by 2024. This could further sideline companies like ChargePoint. Now, let's shift gears and talk about the upcoming trading session's surge signals for the stock. On the upside, we have $4.04, $4.12, and $4.18. On the downside, the numbers are $3.90, $3.84, and $3.76. What does this mean? Well, these surge signals are crucial price points that could confirm a directional move for the stock. If the stock approaches or breaches these levels, it could indicate a potential bullish or bearish trend. For instance, if the stock price moves past $4.18, it could signal a strong upward momentum. Conversely, dropping below $3.76 might indicate a bearish trend. Investors should keep a close eye on these levels as they navigate their trading strategies. That's a wrap on today's deep dive. If you found this analysis insightful, don't forget to hit that like button. And if you haven't already, subscribe to our channel for more updates. Once you've subscribed, drop a comment below saying subscribed, and we'll do our best to respond. Now, we'd love to hear from you. Do you think these charging companies can weather the storm, or is it lights out for them? Share your thoughts in the comments below.